got friends only wanna talk business. I got expensive, cause winning's expensive. I got expensive, cause winning's expensive. I've been reading all the war, and I've been shutting down the stars. Yeah.
And welcome to Put That Coffee Down here on FreightWaves TV. It's 12 p.m. Eastern Time on Tuesday, and I'm Kevin Hill, your host. This is the Freight Sales Show for Closers. We have a special guest here with us today. It's Spencer Tenney, the president and CEO over at Tenney Group. We're going to talk about M&A. We're going to talk about financing. We're going to talk about probably banking failures here in a little bit. But let's welcome Spencer onto the show right now. How are you doing today, Spencer?
I'm doing great, Kevin. It's great to be with you.
It's great to see you again. 2023 has been interesting because of deals so far, and that's what you guys do over at the Tenney Group. So let's jump into it. First of all, I have a question for you because I did an interview about suggestions in a playbook for anyone who wanted to start a trucking fleet and grow it or grow their trucking fleet right now. Maybe it's 10 or 20 trucks to 1,000 trucks. And whether it's a playbook or maybe one or two things that you just have to keep in mind, or maybe the most important things. And I wanted to ask you that first, right off the bat.
Well, I would say that the population of business owners that have started with one truck and got to 1,000 is pretty small. So I think my just recognizing the realities of how challenging that is to home grow that result. I think that the first thing I would say is that you got to start with a foundation, because there's if you can skip a couple iterations of the growing cycle pains, then you'll be much further along. So if you at least start with the foundation of maybe 200 trucks, the probability of getting to 1,000 trucks exponentially goes up, just because you have the infrastructure in place and a team to help you get where you want to go. And quite honestly, just to do it from one truck, it's just a much larger, complex challenge. So I think that would be my recommendation. Set the foundation, get the right people in place that can help. It's a team sport. You want to make sure that you get the right people in place that can help you get where you want to go. And just to increase the, you're a sales guy, increase the closing ratio. Like, that's what we want to do. So that would be my single most important piece of advice.
And that is that's really good. It's really interesting and well put, because it is probably better just to go out and buy a 200 truck fleet to start off, if that's really your goal, right? If you're going out and doing that to raise the money, buy a 200 truck fleet and start there.
Well, you're going to buy it no matter what, no matter how you look at it in terms of all of the expenses, and the data is undeniable, and it's not specific to trucking or anything else in terms of the comparison of buy versus build. There's no comparison. It's not just because of this is what I do. It's just the math. You can't deny it. It's just so much more cost effective to buy an existing machine that has proven results and then stack your investment on top of that versus taking all of the risk on your own shoulders.
Yeah, let's talk about that, because that's a very good point, is buy versus build. And what you said earlier, you're going to pay for it no matter what. Whether you build it or you buy it, you're going to pay for it. It doesn't come for free. So buy and build, what's the analytics behind that in a lot of cases? And what are some of the risks and challenges and opportunities in that?
No, I think if you put it from a sales lens, I mean, I don't know what the exact data, but I think it's something like the cost to maintain a customer is like 7 times less expensive than creating a new one. So it's effectively the same concept. Like, if we have, let's call it $50 million, like the cost to just maintain that and build on that is exponentially smaller than it is to go try to create $50 million revenue stream from scratch with new customers and doing that one at a time. So I think it's just about accelerating, about just, chalking it up. Like, here are the known costs that it's going to be required of me to get to this point. So let's just get it at a discount rate, buy it, and then be much more efficient in the way that we make additional investments on top of that.
You're exactly right. It is 7-8 times. I don't know the exact number myself, but it's exponentially smaller to maintain current business than it is to go out and add each new additional customer. And also, one of my points was know your niche and stick to that niche if you're going to grow through that. If you can already buy a niche, it's much easier to stick to it if you already have 200 trucks or 300 or 400, however many that is. Maybe it's just 50, right? It's much easier to stick with that niche than it is to start out and be buying trucks on your own, establishing accounts on your own, and stay really focused to the point where you can build a business and a niche that could get you to 1,000 trucks.
Yeah, I just think that in the absence of anything else, you're effectively just assuming a job, and if you're the one doing all the work, it's very difficult to get out of the weeds and work on the business. And so I think that's just what we're trying to do, is just to make the types of decisions and investments that allow you to build and not just work.
And one of the other points is, if you're going to grow anything to 1,000 trucks or $1 billion in revenue, if you're a freight brokerage, right, you got to know how to do deals. You got to know how to buy businesses, and have to know how to sell yourself once you get to your goal, right?
No, I think that has a big part of it, just in terms of the realities of the marketplace. It's just very difficult to execute if the growth strategy is limited entirely to organic growth methodology. So I just think that just it's just much more practical to have some type of combination of organic and inorganic growth to get where you want to go, specifically in this environment.
And to start knowing how to do deals, you need advisors for those deals. And you've been doing deals in this space for a long time. How long have you been doing deals, Spencer?
Well, I grew up in it. My dad started advising on deals in the transportation space back in 1973, and so I've been with it's been in the family for as long as I could know. I mean, he used to take me to trade shows, and we were part of best practice groups, and I would get to sit on conversations involving M&A. So it's very fortunate to have had that experience. But on the professional level, the last 25 years, this is basically what I've done. And we have a great team over at Tenney Group. We're trying to help as many folks as we can, and primarily serving that lower middle market, which is your kind of 20 to 300 million in annual revenue, and which is highly underserved. It's a little bit too big for your kind of generalists to understand, and then maybe not quite large enough for your premier global investment banks for the math to make sense for them to get involved. So to me, it's just a privilege. We get to help people, whether they're growing through acquisition or living the American dream and exiting on something that it's their life's work. It's just a tremendous privilege to be a part of this community and to be a part of this important point in people's lives.
And doing deals in trucking is different than other industries. I mean, it really is, because it is very capital intensive. It's very asset heavy. It's very competitive. What are some of the big differences that you lead in? Here's the major difference. Here are the top 3 major differences. Whatever that number is. Major differences in buying and selling trucking companies rather than almost any other industry.
Well, I think that right off there's it's not for every investor. I think just the CapEx nature of what this is, it's very difficult, for instance, for just a general private equity group to understand and get their mind around an investment thesis. Or how are we going to get an effective competitive return if every 3 to 5 years we're having to turn over the whole fleet? Like how does that work? And so number one, I think it's complicated because we need a very educated investor that understands the nuances of this industry. We also need, we have to get funding. So whether it's the capital source or whether it is on the senior debt, there has to have an appetite, and that we can get a deal at a valuation that they feel comfortable with, debt covenants and things of that nature. And then, highly cyclical in some ways, depending on what vertical you're in this space. And so that there's always, when we're trying to negotiate and think about net working capital and how do we calculate that and who retains that? I think there's some elements of that are very specific to this industry that can really become problematic when we're trying to iron out all the things. And then, lastly, I would say just in terms of on the risk and the diligence, all the things that we have to consider when you think about nuclear verdicts and exposure, that we're transferring risk from one party to another. It's just a host of things for people to get their mind around. And that's why we exist. I mean, our objective, although we represent probably 95% of our 18 deals that we do right now, we're representing the sellers, but we're also providing insurance for the buyers, because when we inevitably have some type of discovery or a challenge that affects both parties, like, we're there to provide a solve that helps people mitigate risk, share risk appropriately, and get a deal to the finish line. And so I think it's not easy, but it sure is fun.
It isn't. It isn't easy whatsoever. And I talk about picking your niche here on Put That Coffee Down constantly, like a broken record almost. And I think the deals that make the most sense, especially for like private equity or outside investors, or for really any investors, or those trucking companies that have built up around a niche, whether that's tanker, the tanker business always seems like it's a good play. If you focus in on one specific type of commodity, if you focus in on equipment type, maybe just heavy haul, just a really highly specialized book of business and equipment seems to counter some of the market cyclicalness of, so the market cycles, right? It kind of combats the market cycles, makes the earnings not quite as volatile as maybe a regular dry van business that's over the road and kind of all over the map. That's much harder entity to sell, I think, than a business that's focused around a heavy specialization where you can have predictable earnings.
No, I think that's completely true. And probably one of the most direct examples of that was the deal that we did with Keenan Advantage Group and American Petrolog, where, American Petrolog was a very defined interest in terms of, their specific brokerage presence within the liquid bulk space, and there's some transloading element to that as well. And there was nothing like them. And so, Keenan, who's one of the most prolific acquirers in the entire space, clearly recognized the uniqueness of it and how it was an immediate competitive advantage, value add to what they were doing, complementary. And to your point about it, it wouldn't matter what environment we were in, that it was going to pop in terms as an offering to the marketplace, because and even in market, like, I would even kind of double down on what you said, because from a differentiation standpoint, when you do have a niche offering in a market where it is a little bit softer as it is right now, it pops even more as far as, like, demonstrating its value based on what the environment is doing to other companies. And if there's some insulation from that, it makes it shine even brighter.
Yeah, I mean, you want to build a business. We talk about sustainable businesses, right? You want to build a business where you go back into that build or buy for larger players, and you want to build a business that is a more attractive buy rather than build for a larger company. It is a great strategy to operate your business on, especially if you want to sell it eventually at the end of the day, right?
Well, yeah, and I think that the challenge, and this is true of every business owner, but the challenge, like, when you have something like the niche, is to understand, like, where are there going to be growth constraints? Because, like, if you could grow a niche to, multi-billion, then it's probably not really a niche. So maybe, but I think that the issue is for those that have done it, like, built something and exited. Just to use the same example, I mean, that's a 7-year start to exit window where they had a tremendous track record of sustained, compelling growth, and there was still some meat on the bone for the acquirer to go continue that growth story. I think where some of the challenges on some of the niche operators is perhaps if they exhaust whatever they exhaust the market, they get too far, and there's no place for the acquirer to take it. So it's effectively staying at the table a little too long, and then the investment story or thesis for the buyers not as attractive as it would be otherwise if there was still a little runway for the growth to take place.
True, very true, very true. Well, let's talk about 2023 and kind of some of the deals on the table or the chatter around the market and has anything been surprising so far this year? Already in the first 4 months of the year, or maybe what you expect in the back half?
No, well, I wouldn't characterize it as unexpected. I think that we were expecting shifts in the freight market and expected that to affect the way that deals get done. And I would say that, there's still very high M&A activity, but, when you're seeing what's happening in the freight markets, it's naturally going to affect the way that buyers and lenders and sellers see risk as far as the outlook moving forward and how they structure deals around that. So right now, I think that we have, tremendous engagement in the, the 18 active sell side engagements that we represent. And, some of those are in different processes. And the realities are like if the business is changing up or down, like you have to account for that in deal structure. And so what that means is that you're, perhaps seeing some shift to earn out, or maybe there might be some wait and see elements to that. Just to, if there's something appears to be, very temporary, it's not uncommon at all for people to just press the pause button. Let's evaluate for the next 90 days, make sure that we don't have any blind spots about this before we, start writing very large checks for an acquisition. So we're seeing some of that, but we're also seeing a continuation of what started back in Q4, which is just tremendous new activity from buyers that have really not been in the game for years, but now because the markets have normalized a little bit, they've known that they've needed to integrate acquisitions as part of their broader growth strategy, and not trying to be opportunistic as much more as just like, hey, we've been waiting for the markets to cool a little bit in terms of what was going on, but now we have to make some moves to go catch up and offset some of these inflated costs, especially while the freight market's a little softer. It's even more urgent to kind of make some of these moves to create the synergies necessary to be sustainable moving forward.
We were talking about synergies. Is it more on the cost side, capturing synergies on the cost side because of rising costs, or on the capability side for their customer base because of the pandemic and the chaos and the supply chain constraints there? When you're talking about urgency or the need, is it coming from both sides equally, or?
I think it's both. I think it's both. It's both. I mean, I think when you see labor costs go up and then spot market going down, significantly, that creates a major effect on the bottom line and the earnings. And so I think that this would be happening irrespective of what's going on in the market. It's just that when the freight market is down, it just makes the pain of those inflated expenses that much, more pronounced. So I think part of what the continuation is, people have been, it's a low margin industry. You have to constantly be thinking about how to advance your capabilities and path to profitability. And so for some people, that's organic growth, that's expanding, that's reducing costs. But in a low margin industry, there's only so many pennies that you can squeeze out of a dollar. You have to start doing some things that are synergistic to offset, the way that these expenses are increasing. So I think the need to enhance capabilities to meet the demands of the consumer, that's part of it, like to be relevant. And then the other part of it is you have to have a cost structure that is sustainable. And without some synergies, without some purchasing power through bulk, through volume, it's just very challenging to do that. So I think that's why we're seeing, irrespective of what's happening in the capital markets with rising interest rates, like the cost of doing nothing right now is much more damaging than absorbing some additional interest expense, because, if your labor is up at 20, 30%, you're not going to be able to shave that through cost cutting. Like, you're going to have to figure out some other ways to address that.
You are. You mentioned raising interest rates. Has there been change in appetite with banking and lenders because of the hit regional banks are taking right now because of SVB and First Republic, or is that not really too much of a concern right now?
I mean, I think it's very real for your larger deals. I mean, it's very, that has significant influence on the way that deals are thought about. When you start getting into that kind of 9-figure threshold of total transaction value, it's definitely different in terms of the piecing the puzzle together to get a deal done. And so I do think that the instruments have changed over the last 6 to 12 months as it relates to senior debt, mezz, whatever else, to try to get some of these, given the environment. For smaller and mid-sized deals, less so. There's still a ton of deals because they're highly collateralized through the assets, unless we're talking about brokerage. But so I think major changes for your large kind of transformational deals that require third-party capital or lending, and then but maybe some impact, but not nearly as much as you would think on the the types of transactions that involve, let's say, 50 to 200 trucks.
What's your categorization of small and medium, if you want to go by truck size or revenues? How do you categorize those?
Yeah, I mean, I would say pretty much anything up to 100 million in revenue. That's kind of how I was on the truckload side. And I would say small. Let's say small, maybe 20 to 80 trucks, and then 80 to a couple hundred on that mid-size.
That makes sense. When we talk about buying and selling, we always talk about the top line price. We always talk about doing the deal, kind of like in sales, right? Where we're always focusing on the close, right? That close where you sign on the dotted line. But that's when all the work actually starts. And when you talk about integrations and absorbing and synergies, that's when all the hard work actually begins. And that's something that we don't really talk about or ever really pay attention to. But how important is that? Or what do people get right? What do people often get wrong when it comes to after the cash has changed hands, after it's signed, and when you start doing your earnout, if you're selling your business? I mean, what are some of those pitfalls?
I think the people that are most effective, the acquirers that are most effective post-transaction, there's a couple things that they do that are unique. I think the first thing that they do during due diligence, they are leaned in very heavily on the management team of the target acquisition. And they're learning and they're listening. And they're also demonstrating significant humility and openness about, well, whoever they have on their team may not be the best. There's a reason why they're acquiring these people. So in terms of when they're thinking about integration, they're really thinking about, between the two companies, who are the appropriate leaders to affect change in terms of what we're trying to do moving forward. And sometimes the initial idea is like, we've got the very best of the best, but as they lean in during due diligence and they learn from the target acquisition's operational team, sometimes they discover that we don't have the best. Like, this is why we're buying this company, because they're actually the folks that we need to lean on as far as seeing them as the platform. We've had multiple deals that have happened this way where, maybe a private equity group thinks they have a platform company, and they look at initially as a target acquisition as a bolt-on, something that they'll absorb, capture instant synergies. But after demonstrating some humility, they're like, actually, like, this is the leader of the two. This is the platform for which we will continue to build and invest on. And sometimes it's a blend of the two. But I think the number one thing is demonstrate some humility, to be open to the fact that, hey, you're buying this, making sure that you're extracting the best that you can from a value standpoint. Start with the people, like, in terms of be open to what their capabilities are. The second thing that they do is that they resist, despite the potential immediate synergies, they resist kind of sweeping changes to the organization. Because even through thoughtful due diligence between 90 to 120 days, there's only so much that you can really discover. You have to see what this team does and learn from them post-transaction and find out what are the right adjustments, and listen to the people that are actually doing the work they will help you affect the right change to capture the right long-term synergies that will be sustainable. Because what can happen alternatively, if you move too quickly, you may have synergies for 6 months, but you cut off significant portions or departments of the business that could have offered tremendous value. So I think that like what we see other folks doing, that they show some restraint to make that immediate changes as far as like, hey, let's just take it down. That's the synergies there. And yes, they have a responsibility to deliver value to shareholders. Yes, they're trying to address a very specific problem that probably is cash flow related, that they need to do these things. But I think that they're, using a scalpel versus an axe or a hatchet is probably the right methodology, specifically within that first 90 to 180 days.
Thanks for joining us today on Put That Coffee Down. It was wonderful as always. I think I was on the hot seat a couple weeks ago, but it's always great talking to you.
Well, likewise. I've been waiting for the invite, and you didn't disappoint, and I appreciate you having me on, sir.
You bet. Thank you very much. And with all of that, that's Spencer Tenney, President and CEO over at the Tenney Group, the deal maker himself. And that's going to wrap it for this episode of Put That Coffee Down. See you next week.
I got friends only wanna talk business. I got expensive, cause winning's expensive. I got expensive, cause winning's expensive. I've been reading all the war, and I've been shutting down the stars. Yeah, cause when it rains and it pours, yeah, and I'm ready for some more. Yeah, and I've been reading.